Welcome to Tax Alpha. Today we're going to talk about U.S. citizens living in Canada. Canadian citizens or residents of Canada are required to report their worldwide income to the Canadian government. Any income that they earn outside of Canada is also reported to the country in which it was earned. Now, in contrast, a U.S. citizen must file a complete disclosure of all income earned and assets held to the IRS, the U.S. government, every single year regardless of where they reside. This is an onerous thing for them to do, and it has been derived and made much more complicated out of a 2008 audit of the IRS on a Swiss bank called UBS. They were able to find documented proof that American citizens were being counseled to place money into tax havens outside of the United States. The American government somehow decided that this would equate to $100 billion of annual tax revenue lost. So therefore, they stepped up their compliance requirements for all U.S. citizens, no matter where they are in the world. Failure to file these reports every single year face a maximum $10,000 fine per year per return. Next, it's important to define who in fact is a U.S. citizen. Obviously, if you hold a passport and you are a citizen on paper, that's not an issue. But if you were born in the United States, you are also a U.S. citizen. And if one of your parents were also born in the United States, you are also a U.S. citizen. So there are many people living in Canada who are U.S. citizens and may not even be aware of it. So what are the biggest differences in the tax codes between the United States and Canada? Well, in the IRS tax code, there is no equivalent to what we call deferral. An investor in the United States must report all of the internal earnings of their investments, regardless of whether those tax distributions were made or not. The IRS was concerned that many American citizens resident in the United States and elsewhere were investing in Canadian mutual funds and ETFs where compound growth or deferral is a relatively common use of the code. Therefore, the IRS was able to successfully designate all Canadian mutual funds and ETFs as PFICs. These are a special brand of corporation that require any U.S. citizen investing in them to be able to access the internal earnings of those investments regardless of whether they were distributed or not. Their only other option, which is not one that's attractive, is to simply report the gain or loss in actual fair market value on an annual basis, sometimes called mark to market, in which their American tax return would calculate this fair market value increase as interest income, and they would pay full rates on it in the American tax return. So in conclusion, TFSAs and RESPs are not recognized under the tax convention between the United States and Canadian governments. Therefore, U.S. citizens should not invest in RESPs or TFSAs. The same can be said about Canadian mutual funds and ETFs. Because these are PFICs as per the IRS code, this puts very onerous tax reporting requirements on the U.S. citizen living in Canada investing in those vehicles. Obviously, this is a very complex subject, and I would highly recommend professional cross-border tax advice be obtained by anyone in this position who is a U.S. citizen in Canada. I hope that helped, and we'll see you the next time on Tax Alpha.